My name is Andreas and I've been involved in investment management for the best part of 20 years. But there are still parts of the back-end processes that are quite opaque to me. Part of this is because I basically have no need to understand it and can leave it to colleagues who specialize in it, and part of it is because it can be really complicated. Last week, we saw news headlines emerging out of the US about retail investors ganging up to ramp up stock prices in heavily shorted illiquid companies to drive artificial short squeezes, driving the share prices even higher and enabling the investors to sell and realize gains. On back of these stories, we also saw reports that Robinhood and other retail brokerages started to restrict buying in certain stocks involved in these coordinated actions. And this, of course, has led to accusations that the brokers are trying to help out the hedge funds that are short the stocks targeted. And it also made me curious on why a brokerage would indeed stop a client from trading, as they are, after all, a middleman and should be happy to execute orders. And they can set the price they offer the clients to make sure the trade is profitable. After having spent a bit of time educating myself on how the broker business works earlier today, I am confident that it's not a case of brokerages trying to help out hedge funds. What is going on is instead a function of the following. Firstly, US brokerages are generally offering margin accounts rather than cash accounts. This means that investors do not technically own a stock that they have bought, but instead just assign the rights to it from their brokerages, who retain the actual ownership of the assets. This means that it's easier for the broker to generate additional income by, for example, lending the asset to someone who wants to sell the asset short, and for this privilege collect a borrowing fee. But it also means that the broker is liable in case the investor cannot pay them for a trade. Secondly, between different brokerages sits a clearinghouse that matches the buyers to the sellers of different financial instruments. In the US, the major player is called DTCC, but there are other clearinghouses as well. But they all work in the same way, by providing a balance sheet to guarantee settlements. DTCC accounts for all the transactions during the day, and at the end of the day distribute to or collect from the net proceeds of all the brokers participating in the markets. Also, because settlement of transactions in stock markets generally works on a T+2 basis, meaning that the actual payment for a transaction happens 2 days after the actual transaction. This gives rise to a number of credit exposures in the whole plumbing chain of the financial system, both between an investor and his broker, but also between a broker and the settlement house. Normally, this is not an issue, as the players involved have significant balance sheet capacity to absorb unexpected credit losses. There are quite a few more nuances to the actual mechanics, but what is currently happening is basically that the increased volatility in very illiquid names we are currently seeing, and with these assets and leverage options on these assets being held primarily in margin lending accounts, the credit exposure are becoming much more expensive for players in the system to absorb, as DTCC is telling the market participants that they need higher levels of collateral to trade with them in these securities. This is becoming very expensive for brokers like Robinhood, and this is the reason they are restricting their retail customers to trade in certain names. It is basically not worth it for the increased balance sheet risk that it exposes them to. I hope that was clear, even though quite long. Have a good day, and please continue to follow us on the blog or your choice of social media.